London house prices fell by 2.4% last year. Now, if you're renting in Zone 3 and barely scraping together enough for a pint after bills, that probably sounds like good news. Finally, right? Prices coming down. Maybe there's a chance. Except, rents are up 4.4%, so you're paying more to live in someone else's property whilst the thing you're trying to save for is supposedly getting cheaper. But it doesn't feel cheaper. It doesn't look cheaper. And if you actually try to buy something, anything, you'll quickly realise the numbers still don't work. Because here's what they're not telling you. The housing market isn't recovering. It's fracturing. London's in freefall. The North's barely stable. Flats have become a toxic asset class. And the people who should be buying, the ones with decent jobs, reasonable deposits, no major financial disasters, they're stuck. Not because they're bad with money, not because they're not trying hard enough, but because the system is working exactly as it was designed to. And the uncomfortable truth? 2026 is going to be worse. Quick thing before we get into this. If you want more videos breaking down how Britain's systems actually work, housing, wages, cost of living, all of it, subscribe to Britain Decoded. We're building something here that doesn't exist elsewhere. No spin, just clarity. Right, let's talk about what's really happening. So prices are falling. Transactions have collapsed. Surely that means it's getting easier to buy, right? No, because here's the cruel joke at the centre of all this. Affordability is worse now than it was when prices were higher. The average UK house costs about £270,000. The average salary? Around £35,000. That's a ratio of roughly 8 to 1. 8 times your annual income just to get a roof over your head. Historically, that number sat closer to 3 or 4. Your parents, if they bought in the 90s or early 2000s, were looking at a completely different equation. The maths just worked. Now, mortgage rates are still sitting at roughly 3 times what they were post-pandemic. The Bank of England has cut rates, yes, but those cuts haven't filtered through in any meaningful way. Lenders are still stress testing you at 7, 8, sometimes 9%, which means even if you can afford the monthly payments now, they're assuming you can't afford them if rates go up. So you've got a situation where houses are technically cheaper, but the cost of borrowing makes them just as unaffordable as they were before. You're trapped between 2 impossible numbers, and if you're a first-time buyer, it's even worse, because the data shows that first-time buyers in London and the South are now looking at cheaper properties than they were a year ago, not because they want to, because they have to. They've been priced out of anything remotely decent, so they're lowering their expectations just to get on the ladder. Meanwhile, if you're renting, and let's be honest, most people watching this probably are, you're stuck paying an average of £1,366 a month. In London, over £2,200. That's up 4.4% year on year. So you can't afford to buy because mortgage rates are too high and stress tests are too strict. But you also can't save for a deposit because rent is eating 40, 50, sometimes 60% of your income. It's not a market, it's a trap. And the people telling you to just save more or move somewhere cheaper are either lying or they bought their house 15 years ago and haven't looked at the numbers since. The system isn't broken, it's working exactly as intended, it's just not designed for you to win. So let's start with what you've probably already heard. Prices are falling. London's down 2.4% year on year. Some areas, North East, parts of Scotland, saw drops of over 5% in a single month. December alone wiped nearly £2,000 off the average asking price compared to the year before. And on the surface that sounds fine, maybe even good if you've been priced out for years. But here's the first thing they're not telling you. These aren't the kinds of falls that make housing affordable. They're the kinds of falls that signal something's breaking. Because when you look closer, it's not evenly distributed. It's not some gentle correction across the board. It's a fracture. The South, London, the commuter belt, coastal towns, is in freefall. Truro's down 2.4%. Torquay, nearly 2%. Bournemouth, 1.8%. These aren't just bad months. These are sustained declines in places that were supposed to be safe bets. Inner London, Northwest London down 2%, West Central down 1.8%. These are postcodes where people bought assuming values only go one direction. Meanwhile, the North is sort of holding. Northeast prices are technically up 5% year on year. Sounds great, doesn't it? except when you realise that 5% growth is on a base that's already half the price of the South. A £150,000 house going up 5% is not the same as a £500,000 house going up 5%, and more importantly, it's still not affordable for the people who live there. So what you've got is a market that's splitting in two, one half collapsing under its own weight, the other half clinging on, but only because it started from such a low point that there's nowhere left to fall. And flats? Flats are in a category of their own. They're down nearly 1% annually, whilst every other property type is still technically growing. Over the last decade, flats have gone up 18%. Terraced houses, 41%. If you own a flat, especially a leasehold flat in a building with cladding issues, rising service charges, or any of the other disasters that have piled up in recent years, you're sitting on what's quietly become the worst asset class in the country. But the price falls? That's just the surface. The really worrying bit is what's happening underneath. Because prices are one thing, volume is another. And volume, the actual number of people buying and selling, is where you see the real story. October 2025, 98,000 transactions. That's down 2.1% on the year before. London, down nearly 20%. 1 in 5 fewer sales than 12 months ago. But here's where it gets stranger. The government has stopped publishing data on new build sales. Not because they don't want to, because there aren't enough transactions to produce a reliable figure. Think about that for a second. The government, who track everything, who love their statistics, who publish reports on the most obscure corners of the economy, have had to stop reporting on new builds because so few are selling that the data's become meaningless. That's not a blip, that's a structural problem, and it gets worse when you look at who's selling, or more accurately, who's not selling. Sales of homes worth over £2 million are down 13%, the sharpest drop recorded all year. The people at the top of the market, the ones with options, the ones who can afford to move, they're pulling out first. They know something. It's the same psychology you see before every crash. The smart money exits quietly, then everyone else realises 6 months later. Now, you might be thinking, okay, but transactions always drop in winter. It's seasonal. People don't move house in December. True. Except December's drop this year was bigger than the 10-year average, and it came on the back of the budget, which created so much uncertainty that buyers and sellers just stopped. The second half of 2025 saw new sellers down 4%, buyer demand down 6%. It wasn't a seasonal slowdown. It was paralysis. And here's the bit that should worry you. Mortgage approvals are still sitting at around 65,000 a month. That's barely above pandemic levels, barely above the point where the entire market ground to a halt. So you've got falling prices, collapsing transaction volumes, and a lending market that's frozen. That's not a correction. That's a market that's stopped functioning properly. And if you're stuck in it, if you're trying to buy or sell or remortgage, you're not dealing with a slow market. You're dealing with one that's actively working against you. Right, so we've covered the price falls, the transaction collapse, the affordability trap, but there's a layer underneath all of this that nobody's talking about. Let's start with flats. If you own a leasehold flat, especially one built in the last 20 years, you're sitting on what might be the single worst investment decision you could have made, and it's not your fault. Flats have gone up 18% over the last decade. Terraced houses, 41%. Detached, even more. That gap isn't closing. It's widening. Why? Service charges that double every few years, leasehold terms that trap you into paying ground rent to some faceless freeholder, buildings with cladding issues that make them unmortgageable, EPC requirements that cost tens of thousands to fix. The list goes on. And when you try to sell, good luck. Buyers know all of this now. They've done the maths. They're not touching flats unless they're desperate or getting a massive discount. So if you bought a flat thinking it was a safe step onto the property ladder, you're now stuck in an asset that's actively losing value relative to everything else. The market has effectively written off an entire property type. Then there's repossessions. Nobody talks about this because the numbers are published quietly, buried in government datasets. But repossessions are ticking up. Yorkshire and the Humber has the highest rate in the country. It's not a crisis yet, but it's there, and it's growing. And here's the thing about repossessions. They're a lagging indicator. People don't lose their homes overnight. They struggle for months, sometimes years, before it gets to that point. which means the repossessions we're seeing now are the result of financial stress that started back in 2023, 2024. The people who are struggling now, the ones whose fixed-rate mortgages are ending, the ones whose rents have gone up 30% in 2 years, the ones who've been made redundant or had their hours cut. They won't show up in the data for another year or two, but they will show up, and then there's the budget. October 2024, the government finally announced what everyone had been waiting for: tax changes, stamp duty tweaks, a council tax surcharge on high-value properties that won't kick in until 2028, but has already spooked the market. The reaction? Immediate. Buyers vanished, sellers pulled listings. The entire second half of 2025 was effectively wiped out by people waiting to see what would happen. And what actually happened? Not much. The changes are incremental. But the uncertainty was enough to kill momentum entirely, which tells you something important. This market isn't being held up by fundamentals anymore. It's being held up by confidence. And the moment that confidence cracks, whether it's a budget announcement, an interest rate shock, or just one too many people realizing the numbers don't work, the whole thing comes down. The RICS, the Royal Institution of Chartered Surveyors, the people who actually know what's happening on the ground, their surveys show buyer demand in negative territory. Estate agents are reporting longer completion times, more deals falling through, more people just walking away. This isn't a market that's recovering, this is a market that's holding its breath. And the longer it holds, the harder the exhale is going to be. So where does that leave us? Prices falling, but not enough to matter. Transactions collapsing because nobody can afford to move. Mortgage rates that trap you even when the Bank of England cuts. Rents climbing faster than wages. Flats becoming unsellable. Repossessions quietly ticking up in the background. And through all of it, the same tired advice. Save more, spend less, move further out, get a better job. As if the problem is you. It's not. The problem is that the housing market in this country hasn't functioned properly for decades. It's not designed to get you housed. It's designed to extract wealth from renters paying someone else's mortgage, from buyers stretching themselves to the absolute limit just to get a foothold, from people trapped in flats they can't sell or stuck in rentals they can't escape. And the fracture we're seeing now, London collapsing whilst the north clings on, flats falling whilst houses hold, transactions disappearing whilst prices stay stubbornly high. That's not a blip. That's the system breaking under its own contradictions, because you can't have a market where houses cost 8 times the average salary and call it functional. You can't have rents rising faster than wages and call it sustainable. You can't have an entire generation priced out of ownership and pretend it's fine because the market will correct itself. It won't. Not without something breaking first. And 2026? It's going to be worse. The budget hangover's still here. Mortgage rates aren't coming down fast enough. Rental supply is shrinking as landlords sell up. And the people who were barely holding on in 2025 are going to find it even harder this year. The uncomfortable truth is this: the housing market isn't collapsing because of some unexpected shock or policy failure. It's collapsing because it was always going to. You can't build a system where the only way to win is to have bought in 20 years ago and expect it to hold forever. And the people telling you otherwise, they already own. They got in when it was still possible, and now they're selling you the dream whilst the door closes behind them. So no, the housing market isn't recovering. It's not finding its level. It's fracturing, slowly, unevenly, but inevitably. And what they're not telling you is that there's no easy way out of this, not for you, not for the millions of people stuck in the same position. The only question left is how long it takes before everyone else realizes it too.